And this is our effort to try to ensure that financing can be provided more broadly to consumers, and particularly to consumers who may not be able to access capital through traditional mechanisms. So this second tier of loans would not be expected to be financed initially through the capital markets, but it would instead be managed as a revolving loan fund. We would then monitor the performance of these loans, and assuming that they perform as we expect, we would monitor the performance data and then could include them at a later time as part of a capital markets financing. So specifically, the standards that we're using on Tier 1 are that a consumer would have a credit score of 640 or higher, a debt-to-income ratio less than 50%, they would not have had any bankruptcies within the last 7 years, and they have no outstanding collections or judgments. The Tier 2 standards, on the other hand, are the same, except that the credit score requirement is substituted with a utility bill payment history, where the consumer would be current for at least 2 consecutive months during each of the last 2 years. And our rationale for structuring the standard in this way is so that we would have principal and interest payments on bonds occurring in those time frames when consumers are most likely to maintain the utility bills on a current status. So the next slide is a summary of the capital markets approach that we would then be using. So after these loans have been purchased by NYSERDA and they're being serviced by our loan servicer, we would aggregate these loans and eventually issue bonds using a master trust structure where we would issue limited revenue obligation bonds. So those bonds would be supported by the cash flows or the loan repayments from the underlying loans, and would also be supported by a loan loss and a debt service reserve, which we will fund using the DOE Better Buildings Grant funds. The proceeds from the bond issuance would then allow us to recycle money back into the program to support new additional loans. Our plan is to have a first issuance of about $25 million, and we would expect that to occur sometime during 2011. We think that bond issuance will carry a rating of at least an A rating, and it will be our intention to, over time, continue to increase the size of those issuances so that we can get more market interest from investors in supporting the efforts. And the initial structure of bonds would be issued as qualified energy conservation bonds. Qualified energy conservation bonds, or QECBs, are tax subsidy bonds. QECBs were originally authorized as tax credit bonds, but then the structure was later changed by the federal government to be their current form of a tax subsidy bond, much like Build America bonds that had been issued quite regularly. QECBs carry a federal interest subsidy of about 70%. So the federal government is essentially paying about 70% of the interest costs on the bonds. QECB bonds were, under the Federal Stimulus Act, received nationally an allocation or volume cap of $3.2 billion. And that amount was allocated amongst the states, and with New York receiving a total of about $202 million. The regulations provided further that the volume cap allocated to each state had to then be sub-allocated amongst large municipalities with population in excess of 100,000. So in New York, that resulted in New York City receiving about $87 million of the allocation, a total of $95 million being allocated to 38 large municipalities, that is counties, cities, and towns in New York, and the remaining approximately $20 million was available for state purposes. This bond volume cap doesn't have an expiration. However, since it was authorized under ERA, like everything authorized under ERA, we think it's falling under a review by Congress as to whether it's being used or not. And so we certainly are trying to promote municipalities who've received these allocations to use their allocation before any subsequent legislation were enacted that could affect its ability to be used. The regulations provide that these bonds can be issued for specific eligible purposes, and primarily those are for energy efficiency in public buildings. And under those instances, not more than 30% of the bonds could be used to finance energy efficiency work in private facilities. However, there is a programmatic purpose that was authorized called a Green Community Program that allows for the proceeds of a QECB bond to be used to fund loans for energy efficiency, including loans to private homeowners and private businesses. Since the federal government is essentially paying 70% of the interest costs on a QECB bond, the resultant net interest cost to the issuer is substantially lower, and using a QECB bond structure would allow us to pass along that lower cost of capital to lower the interest rate that would be charged to borrowers through the program. The state has authorized NYSERDA to use its $20 million allocation in support of the Green Jobs, Green New York program effort, and the regulations do permit local governments who aren't intending to use their allocation to revert their allocation back to the state. And so we have reached out to the 38 local governments in New York who have received QECB allocations and inquiring about their interest in using their allocation. And to date, we've had 4 municipalities agree to revert their allocations back to the state, totaling about $6 million. So to date, we have the ability to issue QECB bonds up to $26 million. And we're hopeful that other local governments may similarly revert their allocations. So once we get to our first issuance, we're anticipating an A rating. We think that the interest costs on the bonds would be about 5.7% based on current Treasury rates and our expected term of those bonds. And after the federal subsidy of about 70%, it would lower the net interest cost to about 2%. So as a result of issuing bonds at a cost less than 2%, we have issued the Green Jobs, Green New York financing program for the residential sector to offer unsecured loans of a term up to 15 years, provided that the term can't exceed the life of the measures. We are providing a reduction in the interest rate of 0.5% for those consumers who elect for automated ACH payment from their bank account. So as a result, in November of last year, we rolled out the program offering an interest rate of 3.99% or 3.49% for those who elect for automatic payment. And again, we would offer this rate for as long as we can support the loans using a QECB bond structure. We believe that once we've exhausted the QECB allocation, our targeted interest rate on the loans would be 5.99% or 5.49% respectively. Okay, a little bit on progress to date. Again, we're a little less than 2 months into the launch of the program. To date, nearly 1,400 audit application requests have been received. Of those, over 900 were approved for free energy audits, and another 100 or so have been approved for reduced cost audits. 239 of those audits have been completed, and those 239 audits have resulted in 51 projects that are approved and are moving forward. We also have received a total of 341 applications for financing. Of those, over 200 have been approved. The other 130 or so have initially been denied financing, and that's because those consumers didn't meet the standards that have been established. To date, there are 15 loans that have closed, totaling about $80,000, and another 25 loans are approved and awaiting closure, and another 142 loans in process. So in total, we have over 200 loans that we're anticipating that would have a capital need of about $1.9 million. We haven't yet rolled out the financing approach for the small commercial, not-for-profit, and multifamily sectors, but we're currently working that approach in anticipation of a launch in the first quarter of 2011. And the approach we're anticipating using would be one where loans would be originated through participating financial institutions. The lenders would have all the credit decisions for the loans using their normal credit standards. And then NYSERDA would participate in the loan by providing half of the capital at no interest to the lender. As a result of that, we would expect that the lenders would offer the loan to the borrowers at an interest rate of about 50% of what their normal rate would have been. And then as those loans are closed, the lenders would have agreements with NYSERDA's loan servicer to share on a pro rata basis the principal payments that are received from borrowers, and NYSERDA and the lenders would share pro rata on any loan defaults. And that covers the presentation, and I've got my contact information here. And for any of those who aren't able to submit questions now, feel free to contact me, and I'll turn it back over to Stuart.
Thank you very much, Jeff, for that fantastic presentation. We have a number of questions coming in from our audience. I'd like to remind everyone, please, on the right-hand side of your screen in the GoToMeeting dialog box, there's a question box. Please type your questions in there, and we will relay to them, Jeff. I'll start out with a question from Chris Carrick regarding the structure of the NYSERDA program in general. Did NYSERDA consider simply providing a loan loss guarantee to private lenders rather than purchasing the loans and using a master loan servicer? What are the advantages and disadvantages of one approach over the other?
Yeah, we did consider that approach, and however, the Green Jobs Green New York legislation required us to administer a revolving loan fund. And our view was that a loan guarantee wouldn't meet the requirements of a revolving loan fund. We are certainly aware that there are opportunities for partnerships with lenders where funds could be provided in the form of guarantees, and that as a result of that, it could allow lenders to lower the cost of capital for their underlying loans. But that's not the initial approach that we're looking to administer as part of Green Jobs Green New York. And it's something, however, that we would continue to keep an eye on and consider if there may be opportunities using other forms of funding to support those kinds of efforts.
Great. Another question concerning program design and some of the incentives available. This comes from Jody Anderson. How are the comprehensive work scopes judged? And this refers to the 5% award incentive for contractors under Energy Star program guidelines.
Yeah. So the program guidelines have provisions whereby if there are a minimum number of measures that are installed in a home, then the contractor is able to earn that incentive. So in other words, if a contractor is only providing one measure to the homeowner, then it doesn't meet the comprehensiveness. But if there's multiple measures that the contractor can encourage the homeowner to undertake, then they are able to earn the incentive.
Another question coming in from Corey Stone. When we look at the homeowner and the different methods of evaluating them, how are you accessing and verifying utility payment history for the Tier 2 borrowers?
The consumers who are not able to meet the credit score requirement are then notified that they can contact their utility and request a account payment history. And we've provided contact information for each of the New York utilities, and we've directed them as to how those consumers can access that. And so the consumer would receive that directly from the utility and then provide that to the lender for its review.
Another question coming in from Jonathan Gorman that builds a bit on the implementation of the program. He's interested in the payback period, looking at a little over $7,000 for the initial investment and $660 on a yearly savings, getting a payback of a little under 12 years. Do you think that this would be the average going forward, or do you think that this will be improved?
I think we would expect that that repayment history would probably remain at about that level. We are encouraging comprehensive efforts. And so we do know that those comprehensive work scopes generally would require a longer payback period. And so the good news is we've been able to structure a financing approach that can support those longer repayment periods even with an unsecured credit structure.